Morning, everybody. Hopefully you had a good long weekend. Restful. All right, green on the screen. A little bit out of Japan. Otherwise, we're recovering off the bottom. We're still red. Small caps are down the most. Well, that's gonna get annoying. Zoom made changes again, so I'm trying to deal with that, but I guess we'll deal with that later. Just a second. Okay. So yeah, small caps down the most, near that 0.5% benchmark. Otherwise, nothing else has moved enough to really hit our radar. And the main thing is that we are coming back up off the bottom. So, from that point of view, it's a little bit of a recovery morning. Other than new home sales, the market watch list is pretty light. If you're unfamiliar with the reason we go to more than one site is because these economic events have different weight to them. Some are considered really important, some, maybe a little important, and then a lot of them are completely ignored. That usually surprises newer traders that, they've heard economic events are important, we need to watch them, but they're not all equal. Some websites list everything they can find or everything they deem important, and then others will only list the top tier things, the things that they feel has a major impact potential, or they won't list it at all. And Market Watch is one of those. So if you're trying to keep your journal light and not really bogged down into every single economic event for the day, this would be the place to go to. Finance Juice is one of those places that tries to list as much as possible, but it also catches things that crop up, like news events, people that are going to be speaking on a very short schedule that just happens to crop up, say, over the weekend. It'll land here. So I like this one a lot. And they also do these summaries when markets open and close, not just in our world, but around the world. So it's kind of nice. We're able to, kind of get a feel for what happened in the overnight hours through, how did the Asian markets do? How did the European markets open? They're still open now. So they give us a European market wrap, even though Europe isn't closed yet, but they do that because they know we're coming on. So, they just give us that early nudge, and it's a nice little summary. Kind of get you prepared for the day, get you looking around to try to identify what happened in the overnight hours. And that's really important from a Monday perspective too, because we're not pricing in just one day, pricing in an entire weekend. This happened to be, a short trading week last week, which makes this even a longer weekend. There's just so much more to price into it. We got Christine Lagarde speaking today. We have additional auctions today, all in the front end. So if you were looking at something like IRX, the 13-week, interest rate, this will be right up front with that. So 11:30 and 1 o'clock, we have those auctions. One thing that stood out a little bit was the before Black Friday, they were talking about how, homes just don't have the buying power, and they were expecting a more muted Black Friday, and yet records were broken on this Black Friday sales. So when they dug a little deeper, it was buy now, pay later. So there's still a strong demand for goods, but the kind of goods bought was also a little different. It wasn't as frivolous, right? It was more of items of need rather than items of play. So coming back to Market Watch for a minute, it's a really good place to look ahead, look down the road, and kind of ask the questions, what do we got on the table this week? And is there anything really big coming along that we need to be aware of? It helps out when you're trying to identify some swing trade opportunities. Initial jobless claims has been kind of the focus, anything to do with job numbers. Then we've got Powell in Atlanta on Friday. It's not supposed to be, he's not going to give policy change statements or anything like that, but, it's certainly worth keeping on your radar. ISM manufacturing is kind of a big deal. PCE this week. Grab your spot gamma levels here. So there's the SPX and the ES. Just grab a screenshot. The SPY. NDX. And the Qs. I don't know if they're running it or not, but if you don't have a screen share program or a screen capture program, there might be a Black Friday event for TechSmith. This is the company that runs Snagit. This is the product that I use. I love this thing. I bought a version of it for my wife. Use this every day. And if you're not good at running software and apps, it has education courses that are built in so that they'll actually teach you how to use the darn thing. All right, volume's not really all that heavy. It's within our range. It's a little light, but not really too big of a deal. Let's just start out on a weekly and realize that there's a really big level coming up. $4,600 is a simple round number to remember, but 4608 is where the proximal line is at. And 46.34 is where the distal line is at. So if we can get through that, we'll have, a new high on the year. And then, of course, we'll have to look left and deal with that October high or December, October, November, December. So it's been an impressive 4 weeks. If we take it from the absolute reversal low down here, then you're looking at an 11% move. That's impressive. But even if we only use those green days, you're still looking at 10.5% in 4 weeks. The S&P has a history of moving 10% for the entire year. That statistical number, by the way, uses 70 years of history. When you cut the history down and ask how much we moved in the last 10 years or 5 years, the number goes up a lot. So, just kind of keep that in mind too. So it's been a TRB. TRB owes us back to the top. When we get there, I've had a lot of people asking, if we're ready for a reversal, if it's time to short. And really, I mean, the short answer to all that is no, it's not. You can take a low risk entry because you're going short off of a resistance level, but there's nothing to suggest that this move is done yet. Even right now, we might be red slightly, just a minor bit, but we're still holding in the upper portion of this candle. 45.50 is last week's midpoint, so that's your halfback mark. We do have a nice setup though, the way that these wicks are formed like this, and we can just use last week's for an example. When you have a bullish close, meaning you close in the upper 50%, and you have a wick across the top and you've pulled back, you have a nice setup. So when the new candle opens, you have a breakout potential. You can get in when it tags the close, or in this case, when it rallied back up through the close, or you can get in after it breaks through the previous bar. So now we've got the same setup here. Low risk entry would be getting in around that 45.50 area. I believe most of us were probably asleep when that happened, so you missed that shot. But now you can trigger long when we go through our own open or Friday's close, or you can have the inside week breakout getting up through that 45.80. When we look left at all these wicks, it does imply that there was a lot of selling up here, and that now that we've gone through it, the question is, have we took out all of that liquidity? And no, pulling and stacking, right? They can reload as soon as we're below that zone again. So just because we closed on the other side of all these wicks doesn't mean anything when it comes to, is there still a lot of selling here? We don't have that answer yet. So if we drop back down through that zone, we'll have our answer. It's a TRB, but it's also considered a cup. So we'd still be looking for a pullback anyways, and then we can measure the entire zone. And the levels that gives us: 48.90, 51.46. I mean, that's some serious projections to the upside. We're through the 20, the 50, the 10, the 200. We're above everything on the weekly. I'm using this higher time frame for a minute because when it comes to brokers and Monday after a weekend like this, the brokers don't necessarily behave the way you think they will. And this isn't going to be the last one, right? We're getting into holiday season. We're going to get more of these short weeks. So what a lot of brokers will do is they'll use this Sunday Globex and they'll tie it in with that short week, that short day from Friday. And so basically from Thursday's close until Monday's open is all going to be wrapped together. Well, let's say that differently. From Thursday's Globex open, Thursday night, to Monday morning is all one chunk of data. So if you're using tools like yesterday's high or yesterday's low, it might not register Friday very well. You're better off focusing on Thursday's close, Friday's open, Globex open. We are inside day. If today closes inside this range, then we will be IX10. If we wanted to use this bigger candle back here, then this is still the one in control. This is the dominant candle. We just happen to have wicked out of it. The thing is, a really big candle like this for an IX10 isn't really impressive. Having a big wide candle for IX10 is basically worthless. If we're using OCR, then we continue to set these higher lows until now, of course, but we had all of these higher lows even through that holiday week. $45.71 is the significant level to deal with. And the halfback 45.45. We've got an MDP. Depends on how you want to count this. We passed through it at the open last night. Otherwise, it's an MDP. And I would honestly count it as an MDP. I don't think it's relevant that we passed through it. So that's a missed daily pivot. It doesn't really weigh on us today. It'll matter more tomorrow. We finally are back with the weekly pivot. You can see it's been quite a while since we've been to that weekly pivot. Here's that weekly. So we spent one day close to that weekly. It was Monday. And then Tuesday, Wednesday, Thursday, Friday, we stayed away from it. The next week, the weekly pivot was brought up to this level. We spent one morning close to it, drove away from it, and stayed away from it again. This week, however, we're there. We've got the weekly pivot point right at our location. So the idea that we're, quote, overbought and we're due a pullback, no. So for everybody thinking, oh man, we've run a long way, let's short this thing. I wouldn't do that if I was you. Don't short it just because we've run, 10% in a month. That's not a good enough reason. Because looking at that weekly pivot point, we're not overbought. 10-day, 30-minute volume profile. When we're at the highs, we expect to go to the lows. When we're at the lows, we expect to go to the highs. We do have a big air pocket down here. So if we break 4,500, we can go to 4,450 really fast. We've seen the examples of that on the way up, how we just cut through there without leaving much of a footprint behind. That would be the same thing in the other direction. TPO says we've spent the most amount of time against this high over the last 10 days. But the greatest amount of volume was still 2 weeks ago around that 45.20 area. which kind of also implies that the move we made to get to this level, we're not seeing capitulation volumes, right? They're not coming in, dumping it, selling out, closing this high level. They're not doing it. So, it reinforces the idea that we're not overbought. And they loaded the boat once we got into this level. So now we've got structure underneath us. $44.10 is the ES put wall. That's all the way down here. All right, we got a new VPOC level from Thursday. I guess that is Friday. Yeah, that's Friday. The thing is, when it comes to this one, it's that same issue. We need Friday and Sunday combined to find out where the VPOC is. So I'm going to mark it just because it shows it here, but that's not a good pivot point to mark, right? When the data is corrupt like this, you're better off just acknowledging that it's corrupt and not marking it at all. I'm going to mark it, but I'm going to change this thing just a little bit so that we understand that it's not our usual VPOC. We're 2.65% above the 10-week. And the reason I've got this much time showing here, this is a 5-year, 1-day. So I wanted to demonstrate how often we go higher than 2.65%. So this is where we're at. My line kind of marks across the screen. And you can see how often we've gone higher than that. So, asking that question, are we overbought? Maybe a little. But even on a weekly, we've still got room to the upside that we could go. And it just implies that there's still room to run. It doesn't owe us a pullback just because of how far we've moved. Now, that is the weekly. So, we can step in a little bit, get a little closer. We're only 0.9%. We're not even 1% from the 10-day. And we're on the decline, no less, right? This slope is coming back down, which really implies we're not overbought. It doesn't owe us a pullback just because of how far we've run. And it's been a great run. I mean, that's fantastic, from 41.22 all the way up to, past 45.22. That's fantastic. But it doesn't owe us a pullback. So, if you're trying to short stuff right now, just because it has made a fantastic move to the upside, and that's your only reason for shorting it, that's a bad idea. I wouldn't do it. Now, if you got more to add to your short, if there's a reason to believe that you should be short a market besides this, then yeah, sure, great. It's also worth noting when we look at last week's box that we stayed in the upper half of that weekly expected move the whole time. We didn't break out and expand beyond it like we did the week before, but we did stay above the midpoint the whole week. So we stayed above Friday's close of the previous week. We stayed above the open the whole week. Just showing that strength, right? That structure. So one of the things that I like to do is measure the previous week and then lay it against our new week. And even though last week was a holiday, which means the range is smaller just because there's less days to be counted, when we compare it with this week's range, it was actually a bigger week last week than this week. That says volatility has dropped off significantly. Not only are we counting more days in this week than we did last week, which would make the range smaller, but it's significantly smaller. Volumes get reduced. Volatility gets reduced like that when markets go to the upside, right? It's the way it works. Volatility tends to fall away as we rise higher. So you can see that move up. You can see this move down. Makes sense. Now, at some point, when we do get, quote, overbought, even though we're rising, the markets will start to get nervous and you'll see volatility rise as the market is rising too. We're not there yet. Ten, 10:30, 11:30, and 1 o'clock. It's a pretty busy day. In the last 5 days, we were dominated by Bitcoin and China ADRs. Behind that, we had precious metals. A little bit of uranium, and then it really just starts to taper off. On the other side of that, bond volatility dropped over 5%. Volatility out of the Russell dropped almost 8%. And banks were down 1.75% over the last 5 days. We've lost 2.25% in the VIX. This morning, however, Bitcoin is down 3%. The China ADRs are down 0.5%. And gold miners are up more than 1.25%. We got bonds up. Bonds aren't up enough, so no reason to hit on the bonds. All right, so what we're looking at here is the Dixie. This is the DXY, the dollar index. We often just shortcut and say the dollar, but this isn't the dollar, right? This is the dollar index. So it's got a lot of different things in it. We got a critical level at 182 cents, but we're a long ways from that. Right now, the half back at 103.46 is the level of concern. Now we can wick through it. We can close underneath it, dancing around this level, but really it needs to hold. So, you know, it's not some fine line in the sand that we have to mark out. And as soon as we break below it, you know, we scream for a short. It's not like that. But we don't want to see a definitive close below, right? And what that would look like is if we had a level of like this 103.46, and then we get a solid close below that, a significant breakthrough that closes at the absolute low. I mean, that's a serious breach, right? Same thing back here. If we get a close that looked like that, that would be a serious breach. This, we're still just holding the line, just fighting it over. So we're at a level of concern. Nice round number says 103. If we break below 103, then it's game on. We'll target 25%, right? Because the halfback play, that's what we target, is a quarter. Well, in this case, it'd be 0.75, but either way, it's still a quarter level. If I'd have drawn it the other way, it would be 25% down here instead of 75, right? So that gets us to 101.5. That's not bad. So, you know, a $1.50 move. You could focus on the UUP if you actually wanted to trade it. The main thing, though, is this dollar pulling back, right? So the dollar index being weak like this, pulling back. Now, you know, a year ago, we were using the Dixie tick for tick. So if it went down even just, you know, 5 cents, if it was going down, the S&P was going up. And if this was going up, the S&P was going down, tick for tick. But that started to change last December. If you guys have been around for a while, probably remember me saying, hey, we're getting into the point where we're starting to disconnect a little bit, and that it's just going to get more and more exaggerated as we go. So now it's not tick for tick. It's not so extreme as every time it goes up, the ES is going down and vice versa. Now it's more of swag levels. As long as we're holding below that 105, 106 area, then there's less weight against the market. But that's only going to be true for so long. If we continue to hold here, the weight still applies. Think of holding your arm over your head, right? Like screwing in a light bulb and you're fighting it and you can't get the bulb in right away. That light bulb is light, right? It's not heavy, but you keep your arms up there. The longer you keep them up there, the heavier that bulb gets, the heavier your arms get, until you just really, you need to bring them back down again. So pulling back off of that high and getting underneath 104, that was, you know, taking a lot of weight off of the S&P and giving it permission or giving it room to run to the upside. But we're still holding this high. So if we hold this high without really continuing to sell off, that weight is going to start building back up in the S&P. We need to continue to drive lower and not hold this level. So one piece at a time, got to get below 103. And then we'll focus on that 101.5 and then back down to 100. The other side of this conversation is the 10-year. And it's the same kind of scenario. Pulling back off of that high took a lot of weight off of the S&P. It's not a teeter-totter. So just because this is going down, the S&P doesn't have to go up. That's not the way it works. But this going down took weight off the S&P and gave it the freedom or the room to run. if the S&P doesn't go up, it won't be because of this, right? It would be because of something else. So that pullback really helped, and we had some fast moves. I mean, it might not look like much, but those were really big moves. So the deal is now, though, same thing. That helped us out a little bit, but if we continue to hold this high, the weight that was taken off is just going to come back again. We can't stay here. So we need to break that 44 and start working our way back down through these levels. A couple ways to do this. I'm on a weekly, so this is a really wide, really big chart. But we can start on this level anyways. So 43.33, that'd be 4.33%. And we got a head and shoulders pattern on the daily, which by itself isn't enough, right? You need more than a head and shoulders. But the measured move for that is 42.86 and then 40.50. We're gapped up a little bit here this morning. But what comes to mind here is pure price method. So when you get a market like this that's pulled back, you want to focus on getting that lower high, and then we need that lower low. Well, I mean, it's not much of a lower high, but we did get that. I wouldn't count that, by the way. Like these moves, when you go to measure them, they need to have enough there to actually be considered a move, right? Say that kind of distance or that. I don't know that this would classify. So we're still in our first pullback. We still need to set that lower high, and then we still need to set that lower low. Until we do, this is just one big move. So as long as we're still holding above 41.25, this is still bullish even in the short term. Now, obviously, you know, if you're in it for 2 days, then the last few days has been a little rough, but we are gapped up. Well, we were, right? This isn't reading. That's why we use the 10-year in the Globex. So there we go. That's what we want to see right there. Continued draws to the downside. We got to kind of unwind this move from last week. And we want to continue to see this fade to the downside. Tesla's up in the pre-market. Apple's flat. Microsoft is down just a little bit. And Google is down. I mean, just a minor amount. Now, I've seen this pattern before. I really don't have a name for it. I'm sure there is one somewhere. But on PayPal, this kind of a move here inside of this bigger candle is kind of priming us up, especially with these 3 lows here combined. So if you're looking for a long play today, This is like a minor TRB setup too. So break above 56 for a long. You could use something like the 57 calls if there is a 57, maybe a 57 and a half. Otherwise, you could use something like the 60 strike calls. Netflix is still bullish. The continuation would be a breakout above 480. And your risk is this high here that's like a 482.70. Yeah, 482.70. $478 is the halfback, so it kind of needs to hold that level. We can wick below it. We just don't want to, continue to drive lower. That 10 or the blue line there needs to really hold if we do get through that halfback. Say like this, like a dragonfly doji, I think that is. One of those dojis. If we get a move like that, it's fine. But we need that follow through. So break above 480, we could target the 483 calls or the 482 and a half calls if there is calls around that level. Otherwise, 485. The out of the money calls are quote riskier, but they're cheaper, right? The in the money calls are less risky, but they're more expensive. So, pick your poison. Of course, if you use a call debit spread, it wouldn't matter either way, right? You could just reduce your risk and reduce that volatility crush at the same time. We kind of got a TRB on NVIDIA, but that earnings day is really kind of screwing everything up. So that is the level of concern. 488.60 is the 50% mark we need to get through. Until we get through that, it's hard to have any kind of a bullish argument. And Amazon is all over the news this morning. They're comparing the amount of shipping that Amazon does. I seen an article on that saying they've now surpassed like UPS and the others. And then I haven't caught the number yet, but the Black Friday numbers was somewhere in the billions for how many dollars spent on Black Friday. And usually there's an article that comes out that lays down a per dollar basis, and they just use a $1, right? So just for some example numbers, say last year's Black Friday was $7 billion between Walmart, Amazon, and Costco. I don't know, just throwing some names there. They did a study and realized that Amazon took, say, 80 cents of that dollar, and then the other 20 cents that was left was spread out between all the other shopping places. Now, that was just numbers. I just pulled those out of thin air, right? That's not the true numbers. But that's the kind of article that I'm looking for. I haven't found it this morning, but they always have it. How much of that dollar was at Amazon compared to anywhere else? So it's not a surprise that they're up this morning. For some continuation levels, we might as well go to a bigger chart. Now, it's not reading everything from the pre-market. We closed at 146.74 and we're at 148.30. So we're above all of this, right? We're sitting up here somewhere. There's 148.17. We're sitting above that. So we want to measure the last big day. We got another $1 from 148.30 to 149.30. And then just using that last big candle, we got a target of 150.91. Call it 151. If we wanted to use this entire range, well, 50% of the entire range gives us the same number, 151. And then 100% of that range gives us 155. So if we do get the breakout continuation, using some 155 calls isn't a bad way to go. And we do have a market maker move this morning on Amazon as well. There's still a lot of work to do here. This is still, got this level of concern. The threat is, and I'm on a weekly chart, the threat is that we see something like this, that we end up breaking through that level and then falling back down in again. So there is still a threat. If we can close above this on a weekly, then we can keep it and we can start focusing on the next zone of concern around that 170 area. So if you're looking for a swing, say March or April's contracts, I think March probably be your better liquidity. Then, grabbing some calls around that 170 might not be a bad idea if you can run it in some kind of spread. I talk frequently about FX Street as a place that you don't want to give them an email address because they'll just harass you with spam mail. But I'd never had an FX Street account, so just a free one, right? Like I signed up for their free service to have access to their email or to their website, I mean. But they had a Black Friday or a Cyber Monday, of course, like everybody else did. And I went ahead and grabbed it. So one of the things that they have is a nice little pre-market summary that they do. And they have a massive Discord I didn't even know about until I signed up. So I think I'm going to be bringing some of their morning briefing or morning insight into the morning briefings. I just picked it up this morning, so I haven't had time to kind of go through everything, but the material that I was looking at was hitting on Euro US dollar. And of course, Europe's open right now. It's one of the things that we focus on every morning, and we focus on when it closes, 10:30, 11 o'clock, because that's where we often see changes in the S&P and in the NASDAQ, right? So I picked it up. I'll let you guys know what I think about the service after having a chance to go through it a little bit. It was $10 a month for the Black Fridays event, so kind of hard to turn that down. It was actually cheaper than that if you bought the yearly subscription, or if you got it for the whole year, I mean, which normally I would do, but I picked up a lot of subscriptions this Black Friday, so. All right, this is a piece of the puzzle that's worth keeping your eye on. The NY Fang. Think of your Magnificent Seven, Apple, Microsoft, Google, NVIDIA. We're right up into this resistance. All right, so we had that beautiful breakout. But we're right up into that resistance level, and it held, right? We pulled back from it. So this has to be a part of the consideration. If the broader market wants to stay bullish, but we don't have the fangs, we don't have the Magnificent Seven, then it's going to be a difficult road ahead, right? The S&P, the NASDAQ, they can grind higher if the Magnificent Seven are paused. If they're not advancing, but they're not declining, okay, we can still advance in the broader market. But if they actually start to fall back, the broader market can't rally if we don't have the fangs at least just holding the line. Now, the NY Fang doesn't move pre-market, so there's nothing in there. We can use our own little homemade ETF. We can look at it through that lens, but this tool is just a math formula, so it's not moving. We were holding that 50% mark, and that needs to continue to hold. Otherwise, we're going to focus on getting a leg down, kind of a handle on this cup. So here's the Magnificent Seven with some weightings on it. Normally, I would just use Thinkorswim without weights. You get nearly the same chart either way. The wicks might be a little different because of these weights, but the shape of everything is still the same. So we can see how this looks very similar to the NY Fang chart that we were just looking at, right? Except the difference here is we actually closed above that pivot point of concern, right? This one right here. Now that we've closed above it, we kind of need to hold it. So this thing it's not better, worse, right or wrong. It's just, it works in the pre-market and the numbers are just a little off compared to the NY Fang. But we can see that it is up in the pre-market this morning. Barely, but it is up. So we do have the fangs holding the line, the Magnificent Seven. That's the whole point of coming over and looking at this. They are holding, not selling off. So there is that. Microsoft slightly down. Apple basically flat. Bullish and bearish for the NASDAQ is basically 50-50, the equal. Not much on either side. Wow. Come on. I guess it needs a moment. We'll come back to it. All right, so they continue to price in the possibility of a rate hike. It's a minor pricing in, like they're not going heavy on it, but this does show a little bit of concern, right? They were much more aggressive on the idea that the Fed was going to hold without raising rates, and now they're backing off on that. Only a little bit, right? But it does show that the consensus has broken. And that's for the December 13 meeting. For January, they're still pricing in the idea that we'll be where we are right now at that 525. They actually increased that a little bit, unwound a rate hike, 25 basis point rate hike. They unwound it just a little bit. So here they're slacking off, but in December, they're still pricing it in. And they're still pricing in a cut for March. So they're bringing it forward, right? They're bringing it forward quite a bit. It was the July meeting, and then it was May. Now we're in March. So they're bringing up the timeline. Hey, there it is. So things down this morning, nat gas, Bitcoin, energy through USO and through energy exploration, China ADRs, all of that is down. And the things that are up, precious metals, gold, silver, and that's, I mean, that's it. Bonds are trying to come up, but they're just not up enough. So we need more. That's going to be what I'm focusing on today. I want to see the bonds. We've got stocks and bonds rising together right now. They're doing well, holding above that VWAP without being, exaggerated in their movement. So they're looking good so far. I want to see that continue. Let's get the dollar to break this 103 bottom and stretch to the downside with a nice follow through on the 10-year. If we can get these two to continue moving to the downside, we should have a nice, decent move to the upside today. Nothing extreme, right? We're not looking for big blowout, exaggerated moves. Just a gentle continuation while we're waiting on some econ. Be careful, be safe. Have a good day, guys. I'll see y'all tomorrow.